Good morning. Welcome to Trading Hour. This is Trading Hour post the RBI monetary policy, though of course the coverage will continue. Voices, expert opinion, the impact on the market. We'll keep tracking that for you through the course of the day. For now, the Nifty is holding up with a triple-digit gain. The Nifty is up 120 points, around that 17,850 mark. Very, very steady through the course of the day. The Sensex is higher by 330 points. Mid-caps largely keeping in step. The advanced decline ratio has got 3 stocks in the green for 2 in the red. Banks are trailing, relatively underperforming. The Nifty Bank is absolutely flat. And the other interest-sensitive sector, that's the real estate. The real estate sector is down close to about 0.8%. Just want to pick up a point that Anurag was making. They're saying that now interest rates are going to breach the 9.5% mark if you take into account today's interest rate hike. And so therefore, they're saying there is a possibility that the affordable and the lower mid-range housing segment, which are more cost-conscious, will start seeing an impact. Because on one hand, the EMIs are going to continue to rise with this latest rate hike, and plus property prices too have gone up over the last 2 quarters. So real estate is a segment, particularly the cost-conscious, the value buys at the lower end and the mid to lower end, that could be potentially affected. So real estate is a bit subdued in trade.
Hi ladies, good morning to both of you. I've just been watching the reaction both in the equity as well as in the bond and rupee markets, and it's very interesting. Look at the Nifty. The Nifty is flying away, absolutely no problem as far as the headline index is concerned. And then look at the bank Nifty, and that's telling you bonds sold off, not too much, but bonds have also sold off. The benchmark yield is now actually inching to almost 7.34, and that's the Nifty Bank. Bang at 10 o'clock, you get that announcement, and then it starts cooling off. Why, you would argue, because 25 basis points was on expected lines, nothing out of the textbook there. It's probably to do with the MPC statement that I'm reading out. The MPC is of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored. So, though the governor himself has said that inflation seems to be now, on a declining trajectory, overall the MPC view still seems to be that of a lot of caution with respect to inflation, and that's keeping, I guess, traders on tenterhooks for the time being. So banks selling off, bonds selling off, but then we have the rest of the market that's doing really well today, Pavitra.
Oh, absolutely. And actually, let's continue this talk on the market and invite our guest on the show now. We do have Ajay Srivastava of Dimensions Corporate Finance Services joining us right now to take some questions. Mr. Srivastava, thanks a lot for joining us. This is Pavitra. Your first thoughts on what came out of the RBI policy? I mean, of course, they've hiked by 25 basis points, but like Surbhi was pointing out, there still, seems to be caution in the tone of the Reserve Bank. So your thoughts?
Good morning. I think caution is all in the words. The reality is a 7.8% headline Q1 growth rate by RBI tells us the story. The story is RBI is going for growth. Inflation is not going below 5 next year. They don't care about it. So for the corporate, if you're a corporate today, it's good news for you because this RBI is now clearly focused on getting you to growth. It did not say I'll bring the growth down to get inflation below 4% the target. It said let the growth be 7.8. Now that's beyond anyone's imagination. So if an RBI is targeting 7.8, notwithstanding that inflation is not going to go below 5%, it's very, very good news for the corporate. That means the pivots are going to be open, the government will fund the growth, and therefore take that very clear maxim. The reality is growth at 7.8, inflation above 5, the fight of inflation is gone. We are back in the growth business. Very good news for equity market. Maybe bad news for banks because they need to find funding for the deposits, but that's good news for you as a depositor. So you have a good, if you're a depositor, you got the best of times coming. If you're a consumer, brace yourself. RBI is not going to protect you from inflation. If you're a corporate, 7.8% growth, go for it, guys. Best news possible.
Ajay, while the RBI is gunning for growth, most of the economists we spoke to seem to indicate that the RBI's projections for growth are optimistic. So 7.8 is what they've projected for Q1 of FY24, but for the full year, they're at 6.4%. Upasana Bharadwaj of HSBC was saying that we're below consensus at 5.6%. So, it's clearly a divided house when it comes to what the actual growth rate is going to be. Would you say the growth rate is overly optimistic and therefore we shouldn't jump on the growth bandwagon?
You may be right that the growth could be overly optimistic, but I am certainly not in the economist pessimist bandwagon of 5%. At the end of the day, the capex spend of 10 lakh crore is going to come out somewhere in the system. It's not consumer spending, it's capex spending. So, if you run by my company or my business by economists, maybe I'll be dead by now. Okay, so believe them, but not too much of it. I would say 7.8 is an overreach by the RBI governor, but we are certainly on the trajectory of higher growth. I think the important point is that the central bank is plumbing for growth along with the government in an election year. And I think that's the takeaway from this credit policy. We can argue, is it going to be 7.8, 7.2, 7.6? We can argue 0.2% here or there. The fact is, trajectory is growth is on top of the agenda in the election year, both for central bank and for the government. So leave aside the economists. I think they do their work, whatever they do. But I think if you're a corporate, you'll be planning for growth and not getting pessimistic about 5.5% growth rates and so on.
That's the takeaway, right? Pre-election year, election year, and the RBI and the government, they want growth.
And perhaps so does the rest of the country.
So
I get Ajay's point on not being a pessimist. Ajay, good morning, Surabhi here. Great talking to you.
Good morning, Surabhi.
And you're rarely in the pessimist camp, right? All these years that I've been speaking to you, unless there's something really big out there, a black swan, you're rarely in the pessimist camp, which is a good thing. So what are you buying? Because there's been a sale underway in the markets. So tell us, since you are optimistic and you're looking at growth, so what are you buying?
Surabhi, you've been missing me of late. I can tell you that. Since the last 8 months, I've been telling all your channels, spend your money, don't invest the money. And I'm very clear in that, still in the firm path, that spending your money is the best way to use your money. So in an economy we are in the pricing we are in Indian equity market, you cannot make money on stocks. It's very, very difficult. It's it's going to be a tough climb for any fund manager to make money compared to fixed income. So if you really want to make money, spend it or put in fixed income. You want to gamble with equities? Go ahead, be my guest. But I don't think equity returns in the next 12 months are going to be anywhere close to fixed income returns with the volatility that comes with it. So yes, I'm optimistic, but I still believe that spending your money or putting in fixed income is a better idea today than putting in equities at these valuations. Pick up any good company, Surabhi, in India. Any good company did a very good result. Let's take Naveen Fluorine, which gave a beautiful result. P's of 80 and above. Now, how do you justify buying those companies? So leave aside the fiasco of Adani Group, etc. Any other company which is good is expensive. Maybe barring an ITC is something which you may think is cheap. But in a whole economy of India, in the whole market, you don't find cheap stocks. So spend it or invest in fixed income.
But Ajay, that's been the reality for Indian stocks since Kingdom Come, right? Time immemorial. We've never been in a cheap market. Anyway, I won't push you on, giving an equity outlook. But if you're looking at fixed income, then what's your expectation from that market?
See, fixed income market is a very good market today because the options have become multifold, and you are for the first time vis-a-vis the banks are in a commanding position. The debentures in the market are 12% and above. Even double-rated debentures are 12%. Now, to get a 12% return in the next 2 years on equity is a very difficult task at the end of the day. So I would still say that plumbing for 2 to 3 year, 4 year debentures is a good strategy to have at this point of time. There's not much liquidity in large size debentures, but that's the liquidity. The REITs are good at this point of time. Fixed deposit, if you like bank fixed deposit, they're good. But I think the bottom line is equity investment has to be done sparingly in clean companies, in clear companies. And I still believe that equity investment, if you really want to do it, should be focused on where the government is spending the money, which is infrastructure services companies. Those are the ones which are going to gain because they will get the order, they will execute. So whether it is your execution companies and whether it is your company like Siemens, etc., who bring in the locomotives in the country, whether it's a CG Power, those are kind of companies we have invested in. Those are kind of companies which is going to gain from it. The fact is India's consumer story is struggling at this point of time. So you're really focused, you're very, very narrow segment of equity market. Now, can it take the market up? That's where my doubt is. Because if you put out all the capex related companies, they're not more than 10 in this country. Now, can 10 companies create a summer for Indian investors? I doubt it. But if you're a hardcore investor, maybe that's the place you focus your life and rest put it in fixed income. Wait for another day. No hurry. As market tells you, you always get a chance to get in.
All right, Ajay, thanks a lot for joining us and taking us through.
You're welcome. Have a good day.
You too. Have a good day. Thanks for taking us through your, first reading of the RBI policy that's come through. That's Ajay Srivastava sounding very optimistic that, the RBI has such a high growth projection. Maybe not that optimistic on the market.
And yet he's not buying stocks.
He's not buying stocks.
That's one view.
All right, that's one view. But with that, we are going to get into a short break. We are in the middle of the earnings season, so there's lots to talk about. When we come back, we will speak to the management of CreditAccess Grameen to discuss the company's third quarter.
Welcome back. Let's get chatting about CreditAccess Grameen. That's surging in trade. The stock is up 6% after what was an operationally strong numbers. The company has seen an improvement in its return ratios as well. To discuss the outlook, we're now joined by Uday Kumar Hebar, the MD and CEO of the company. Morning, and thanks so much for joining in. It's a good quarter for you, Mr. Hebar. Profits too ahead of street expectations. But could we talk a bit about the Madura legacy book? Because you have indicated that you plan to write off a portion about it, which will increase your credit costs in Q4. Some details about this and the way forward.
So we have we have a very small legacy book, which is 8% of Madura book, and on a consolidated, it's just 1.7% of the book, which was little old model, and we are little unable to completely control the cost. That is why, because of that, our total credit cost might go up by about 30 bps. That's the only change. As we guided only 2% cost, probably we'll end up at 2.3 cost because this additional cost we are anticipating. We thought we'll tell this upfront. So in the meantime, this will not impact our ROE. We are able to pass on the credit cost or pass on the pricing. So we are able to price it better so that our ROA and ROA will be intact. That's our guidance on ROA is still intact and ROE is intact. Therefore, it won't impact the bottom line.
So FY23 credit cost guidance has gone up from 2% to 2.3%, a 30 bips increase. For Q4, what could that number look like, and will it impact FY24, either the first half of the year, Q1 FY24, Q2 FY24?
So we guided about 4% ROA for this year, and we will be able to achieve that. That's what our guidance, which means with the 2.3%. Probably the credit cost, 4% ROA, 16 to 18% ROE, and about 24-25% growth. This is intact. We'll be able to do that. For FY24, we yet to establish, but our aim is to grow in the similar 20-25% growth of growth, and credit cost should come down by 30-40 bips, or it may be around 1.5 to 1.6%. That is what we estimate for the FY23-24. This year, we estimate little higher because we still had some legacy book at the start of the year, which was impacted because of COVID. Therefore, we estimated little higher than the next potential year.
Okay. All right. Good morning, Mr. Hebar. Thanks for joining us. If I can ask you on the margins that you've seen, it's been pretty flat at around 12%. This is in spite of the fact that your yield has gone up by around 50 bips. I'm guessing on account of higher cost of funds. But can you tell us what is the outlook for the margin? Do you see it expanding materially from this 12% kind of level?
Yeah. There's two important factors here. We were about 12% both quarters, but we had little higher liquidity during the Q3 because we raised a lot of international borrowing and we raised NCD, as you know. All these have impacted little higher carrying cost of the liquidity, which impacted by about 11 bips. Therefore, it looks like it's flat. But our view is that our NIM should be around 12.25% going forward, and which will be stable. So, and which will be quite stable going forward. With increased benefit of price, we will get the full benefit by only entire 2 years' time. As of now, we got more than 50% benefit. The remaining benefit we will get in the next 12 months' time.
Okay, so you're expecting NIMs to climb up and remain above 12% as well. Mr. Hebar, almost 12.5, got that. Can we talk about business growth itself, and if you can give us some projections, because your new new borrower additions have been pretty strong. You added a little over 3 lakh borrowers in this quarter versus about, I think, 2.8 lakhs in the previous one in Q2. So what is the outlook in terms of adding new borrowers and a ballpark estimate of how much you'll grow the book by in FY24? If you can share some estimates with us, that would really help.
Our estimate is to grow between 20 to 25% asset growth and 10 to 12% or even up to 15% customer growth. So we are already in that kind of trajectory, adding more than 100,000 customers every month, which is quite a good and positive in terms of a robust expansion. New branches we added this year. This quarter again we are at 40 branches, and next quarter again we are planning some more branches. So which means with the adding up about 10 to 12% branches, we'll add about 12 to 15% customers and grow between 20 to 25%. This is what our plan, which we have to be finalized by end of the year, but we should be around that range.
Okay, got that. So yeah, that really does help, and perhaps so you're out of time right now. Next time we'll chat about the geographical spread where the business is coming from, whether you're moving beyond some of the key states. But that's a conversation for later. For now, thank you very much for joining in with a quick take on the performance. Stocks doing really well, 6% on CreditAccess as we see it this morning. We'll take a break. On the other side, we will come back with yet another earnings conversation. The management of Wonderla Holiday will join in. Welcome back. As promised, let's get into that conversation with the management of Wonderla Holidays. The company delivered, let's say, a wonderful performance in the third quarter, and this was led by domestic bookings during the festive season. We have the revival in walk-in inquiries as well as student excursion trips, which actually boosted footfalls. Let's actually get to the management. We have the management now joining in to take the conversation forward. I think, yeah, Varun is with us from Wonderla Holidays. Varun, thanks very much for being here. I mean, the numbers look absolutely breathtaking, 134% up on the top line. EBITDA is up 284%. And profits, I mean, it's quite obvious because there's no COVID this year in the third quarter versus the trace COVID elements last year. But even if I look at the pre-COVID levels, your growth rates, your pricing is higher than where it was pre-COVID as well. So tell us,
yes, that's correct.
Third quarter anyway is the best for entertainment, for tourism companies. What about Q4 and beyond? Do you see this level of momentum on footfalls, on pricing? Do you see this continuing?
First of all, thank you for having me on the show. Yeah, so I think Q3 is a very strong quarter for us. I mean, historically as well. It's not the strongest quarter of the year, that is Q1. Q1 and Q3 are the strongest quarters, and Q2 and Q4 are relatively, busy. But having said that, we are seeing a strong trend of, surpassing our previous record year in terms of performance for all the quarters so far. So even if you look at Q2, we had almost 60% growth compared to pre-pandemic, and we are hoping that that trend will continue for at least another 1 or 2 quarters. Yes.
Arun, just a question. In Q3, how much was your pricing higher than, let's say, the immediate previous quarter or even last year? Or let's say pre-COVID? I'm just trying to understand pricing trends as well as footfalls.
See, compared to pre-COVID, which was 2 years back, obviously our pricing has gone up with inflation. So we've been able to do that price hike. So it's roughly about 23 to 25% in terms of our price hikes compared to pre-COVID. So that will continue for Q4 and going forward as well. Obviously, the pricing today is different from what it was in 2020.
What was the ARPU number, Arun, for Q3?
I think our ARPU number is about... 1 second. Yeah, it's about 1,200 rupees.
Okay, so this is lower than what we had in Q1 and Q2 because your H1 ARPU number was more than 1,300, 1,321.
Yes. Yeah, so I think we are around that same. Q1 ARPU, this will be around the same. I think about 1,200 to 1,300. Yes, that's the number.
And that's the number which should sustain?
Yes, it will sustain. It will come down in Q4 a little bit because we have a higher percentage of school kids coming. And in fact, even in Q3 also, one of the reasons why our ARPU is a little lower than Q1 is because we have more discounted tickets being sold in that quarter. Q3 and Q4 will have higher percentage of discounted tickets.
All right. Hi, Arun. Thanks for joining us. Can you tell us a little bit about the footfalls? I know for Q3, it's around 30% higher than what we saw pre-COVID as well. But like you were pointing out, the third quarter is, generally stronger for you. Can you tell us what you see as a sustainable range for the footfalls?
Sorry, I missed your question. My connection was...
I was asking you on the footfalls that you've seen. I know for Q3, it's around 28% higher than the pre-COVID level. What do you see as a sustainable rate? Because, like you were mentioning, this is a seasonally strong quarter for the company.
Yeah, so I mean, even this Q4 also, we can see, increase in footfalls. Maybe not 25%, but maybe a little lower. But definitely much higher than pre-COVID numbers we can expect. But double-digit growth in footfall numbers we can expect even in Q4.
Arun, let's talk about the new parks that you are building. There's one in Odisha, I think one in Chennai as well. I have multiple questions. When do they open? As in, when do they start contributing? And in terms of the capex, how much is the total spend? And is all of that from internal cash? If you could just tell us about the cash levels as well.
Yeah, so I mean, we have, like you rightly said, we have 2 new projects which have been green lighted. One is Chennai. Currently, Chennai, we have invested about 120 crores, and we are still waiting for the Tamil Nadu government to talk to us about to give us a waiver on the LBT tax so that we can continue with our project. As of now, we have put it on hold. But we are expecting a positive response from the Tamil Nadu government. And then at that point, we will resume construction. We are doing some basic maintenance work and some small investment in Chennai at this point. The second project that we are doing is the one in Orissa. That, we already got the land.
I think we've just lost that line with Arun. Those are 2 parks. It seems the Tamil Nadu one is on hold. They're waiting for some tax incentives. But the Odisha one perhaps is going to come up a little sooner. That was Wonderla Holidays. We will take a very quick break on that note. On the other side, we get you excerpts from our conversation with Lucy Baldwin of Citi on the sidelines of the India Investor Conference 2023.
Hey guys, welcome back. You're still tuned into Trading Hour, and let's bring you some exclusive opinion now. Lata caught up with Lucy Baldwin, the Global Head of Markets Research and Equity Advisory of Citi, on the sidelines of the India Investor Conference, and began by asking her how the strong US jobs data really changes Citi's view on what the Fed might do going forward. So let's listen into that.
Look, I think really ultimately the market is trying to understand how strong is this labour market. Clearly that one data point alone suggests it's very strong and suggests there's no imminent recession coming. But I think you have to look at that data alongside other data points. You can see why the market's reaction to it was, oh my goodness, the Fed's going to have to keep going for longer and go higher, and you had a bit of a risk-off moment. There's no doubt that that is the natural conclusion when you see a data set like that coming, having had, I think, 5 months of declining data trends from that perspective. But I think when you sort of broaden it out and you look at some of the other numbers that we've seen come through, there are signs that really inflation is softening. It's clearly off peaks.
Yes.
Goods inflation may well, in many cases, be rolling over and declining. Services inflation clearly still running hot. I mean, our view is that the Fed goes to 5.25, 5.5%, and that's the terminal rate. We don't have a cut this year, but the market, certainly prior to that number, had been super excited that you were going to see that cut coming through later in the year, and that was getting markets incredibly excited.
What's the view on emerging markets? Will EM funds, or would you advise smart money to chase EMs this year rather than DMs?
Yeah, look, it's a great question because, as we know, as the world starts to think about this Fed pivot and perhaps at some point then the cutting and the loosening of financial conditions, it's reasonable to expect to see flows come back into emerging markets, as an asset class, clearly. And I think, in particular, when we look at emerging markets, although we're neutral in aggregate, there's a lot to like. India is a phenomenal example of that. And here at the conference today, we've been talking about the long-term structural benefits here in India. We think India can grow at 6-7% a year. It's very diverse. It's very sustainable growth. But the truth is, as we know, after a good run of equity outperformance, the market valuations are quite elevated. So, for example, for us, from an equity perspective within EM, we actually like China here. And again, there's some fairly obvious reasons for that with the reopening trade. Clearly from a central bank perspective, China's at a different end of the spectrum to most of the world, where most of the developed markets, as we know, have been on a phenomenal hiking path, and indeed many EMs, including LATAM. I think for us, China and the reopening is a big opportunity for people to have a look again at that market from a performance perspective. But medium term, a market like India is going to be a core overweight for many portfolios, no doubt.
This theme that China's reopening and therefore it's more attractive than India, because India all through 22 was an attractive story because it didn't depend on global trade as much as domestic consumption. That theme, hasn't it played out? Because from October to today, Indian equities are a good 6-7% cheaper, and China, I understand, is like almost 20% more expensive, if not more. So has the difference played out, or is there more of China over India?
Yeah, and it's a good question because some of these are also debates around the short term versus the medium term. Because to your point, we think, for example, India is going to be the fastest growing large economy in the world between 22 and 27, which is phenomenally interesting. And that's a core part of why medium term, we know it's going to be an important holding for many clients. Obviously, China has seen this very rapid rebound from a reopening, but at some point there, clearly, you can expect that inflation will bite and the central bank will have to take action. And so at that point, you would expect that market regime and that market dynamic to change. And you're absolutely right. Therein provides an opportunity again for investors to look at India very favourably, one would imagine.
Within India, going by what you're saying, you wouldn't like the tech, but you would like the domestic facing stocks because you are betting on a 5-year good run for the economy. Would that bifurcation be fair?
Yeah, I think India is such a fascinating market because it's not a one-trick pony, as it were, right? You've got an incredibly strong services sector, and to your point within that, it's become this tech and innovation hub for the world, not just domestically very strong, and obviously we all know about the many exciting unicorns here in India, which of course will become back again as a focus for capital markets as activity returns. But also, the big story clearly right now for India is this reconfiguration of global supply chains. It's going to be, I suspect, a theme that shapes our current era for many years. And India should be a massive beneficiary of that. So we'd be looking for sectors where there's that opportunity. As well as that, I think you've got to look for things like the consumer. I mean, we know, again, you have a wonderful growing middle class. You're going from this sort of pyramid shape to a diamond shape, and all the associated consumer spending characteristics that come with that around clearly premiumisation, organisation within urban sectors as well as the rural journey. And that's really very exciting. So we look for those things as well as, of course, some of the broader themes around things like the energy transition.
Okay, now a final question. I don't know if in the last 24 hours or 48 hours that you must have been thinking about India and the investor meet, you may have come across the word Adani. There are some criticisms, allegations made against that group, and those stocks have been falling. Does that spoil the India story for you?
Well, as you know, although I can't comment on the specifics around the Adani companies, I think it's very clear that Adani is not India and it is not the India opportunity. Of course, for all growth markets at this phase of the journey, any issues that look like this will always be treated with questions from investors around resilience, around, clearly governance and clearly that political stability. And I think, certainly we've always found that India has scored very highly from the governance perspective and indeed seems to continue on the improving trend. But yes, of course, these moments always cause investors to look because it's important from a foreign direct investment perspective that confidence is there in the system. And we've seen that confidence has been in this system for many years now, and investors have loved the Indian market, as evidenced by the valuations people are happy to pay.
Very interesting conversation there, but we need to slip into a short break. We'll come back with more on the markets. Welcome back. Markets holding up. 150 points gain on the Nifty. It's the policy day, largely in line with street expectations. The government is pressing the pedal on growth, guiding for 6.4% growth in FY24. The street likes that. And stocks are recovering. Take a look at Bharti Airtel. Bharti Airtel is now recovered 1.5% from the day's low. The bottom line was a miss due to exceptional, but the rest of the numbers, operational, the India mobile numbers, were in line with street expectations. Hero MotoCorp, it's in the red, down 1.8%, but the street is now awaiting what the management has to say in the conference call, and that's scheduled at 12:30 p.m. So that's another stock. TCS has won its largest deal in FY24, so that's fueled the rally in the stock, and Infosys is now moving up in sympathy, and Vodafone Idea Remember, at the beginning of the week on Monday, you got the news about the government conversion, infusion of equity. The stock rallied on Monday, but Tuesday and Wednesday, the stock has been subdued. Well, these are a few stocks that popped up on my radar. Out of time now on Trading Hour. From the entire team, thank you for watching.